India's financial ecosystem is a massive, highly complex web of billions of daily transactions, overlapping institutions, and volatile capital flows. Left alone, it is noise. But a single entity has the statutory authority to capture every one of those interactions and force them into orbit. That entity is the Reserve Bank of India, the apex financial institution of the country. When it was established in 1935, the RBI operated as a private shareholders' bank. It took an act of parliament, the Transfer to Public Ownership Act of 1948, to nationalize the institution, converting it into a fully state-owned entity by the start of 1949. Its modern power extends far beyond the traditional central banking duty of printing money. The RBI exercises womb-to-tomb regulatory control, dictating the exact conditions under which a financial institution is born, how it operates daily, and exactly when it must be liquidated. To understand the Indian economy, we have to map the exact borders of the RBI's jurisdiction. We will trace this power from its absolute monetary core, moving outward through its expanding rings of regulatory oversight, until we hit the constitutional limits that constrain it. Ultimately, understanding the Indian economy requires viewing the RBI as the architect of the market's physical and legal boundaries. The foundation of the RBI's authority stems directly from Section 22 of the Reserve Bank of India Act. This provision grants it the absolute monopoly on the issuance of banknotes across the country, with the sole exception of 1 rupee notes and coins. Because it holds this monopoly, the RBI is strictly responsible for the physical integrity of the nation's legal tender. It enforces a clean note policy, legally mandating that commercial banks withdraw soiled or mutilated currency from circulation to maintain public trust in the paper itself. This conceptual diagram illustrates the core ring of the RBI's power. In 2016, the government modernized the bank's mandate by adopting a flexible inflation targeting framework. The gauge at the center sets a target of 4%, bounded by a 2% floor and a 6% ceiling. Maintaining that target is the legal responsibility of the Monetary Policy Committee. Under Section 45ZB, the 6-member statutory body, split evenly between internal RBI officials and external experts, determines the cost of money in the economy. They manipulate liquidity using specific policy levers. As of the March 2026 cycle, the policy repo rate, the primary signal for lending to banks, is set at 5.25%. The standing deposit facility, the uncollateralized floor for absorbing excess liquidity, sits at 5.00%. The emergency borrowing ceiling, or marginal standing facility, is locked at 5.50%. Simultaneously, banks are forced to park 3.00% of their cash directly with the RBI under the cash reserve ratio and maintain 18% in liquid assets like gold or government bonds under the statutory liquidity ratio. These percentages function as precise, legally binding valves that instantly dictate the flow of credit to over 1 billion people. Stepping outside the monetary core, we reach the second ring of jurisdiction. Here, the RBI executes a dual macro role, managing public debt as the banker to the government and acting as the lender of last resort to commercial banks during systemic crises. Under Section 17(5), it provides ways and means advances. These are specific temporary credit lines that allow the central or state governments to bridge immediate cash flow mismatches, strictly repayable within 3 months. But its power over commercial banks is absolute. Through the Banking Regulation Act of 1949, the RBI wields Sections 22 for licensing, 35 for sudden inspections, and 35A for issuing binding directives. No bank operates without the RBI's constant supervision. This control creates an inevitable legal tension. When the RBI decides to liquidate a bank entirely, does the judiciary have the right to intervene? The Supreme Court addressed this in 1962. In Joseph Karuvala Velukanal v. RBI, the central bank applied to wind up the Palai Central Bank, determining its operations were prejudicial to depositors. The petitioner sued, arguing that Section 38 of the Banking Companies Act made the RBI the sole judge of a bank's survival, framing it as an arbitrary violation of constitutional rights. The Supreme Court dismissed the challenge and upheld the provision, declaring banking to be a public interest business. This ruling established the doctrine of supervisory primacy. The court concluded that the central bank's subjective satisfaction is based on specialized, technical data that standard courts cannot easily replicate. In the realm of financial stability, the Indian legal system officially recognizes that the regulator's speed and technical expertise outrank judicial second-guessing. Financial capital naturally seeks the path of least resistance, constantly innovating to bypass traditional banking rules. To counter this, the RBI's jurisdiction dynamically expands into a third ring, shadow banking. Under Chapter 3B of the RBI Act, the central bank oversees non-banking financial companies. By 2026, it fully implemented a scale-based regulation framework. This categorizes NBFCs by systemic importance, forcing those in the upper layer to comply with strict bank-like prudential norms. The precedent for this deep reach was locked in during the 1987 case RBI v. Peerless. When a shadow bank challenged the RBI's authority to dictate its internal business model, the Supreme Court ruled in favor of the regulator, confirming its broad statutory power to prevent the exploitation of depositors. Today, that exact regulatory philosophy applies to digital infrastructure. Under the Payment and Settlement Systems Act of 2007, the RBI holds authority over the digital movement of money. It directly regulates and oversees the underlying architecture of modern Indian commerce, from UPI to heavy-duty institutional settlements like NEFT and RTGS. As global digital trade expanded, the RBI captured that too. By 2026, it enforced rules on cross-border payment aggregators, implementing a transaction cap of 25 lakh during compliance. Whether it is a physical recurring deposit scheme in 1987 or a cross-border data flow in 2026, the RBI's jurisdiction automatically stretches to capture the public's money wherever it lives. Unlike many Western central banks that focus purely on inflation, the RBI carries a heavy state-mandated developmental role. It is legally obligated to engineer financial inclusion across the nation. It executes this through priority sector lending rules, effectively forcing commercial banks to redirect 40% of their total credit supply towards sectors like agriculture and MSMEs. This composite chart tracks the success of that mandate through the Financial Inclusion Index. By measuring the access, usage, and quality of financial services, the data shows an upward trajectory, reaching a score of 67.0 in March 2025. But this vast mandate to protect the economy does not grant the RBI unlimited power to ban emerging markets. That constitutional boundary was tested in the 2020 Supreme Court case, Internet and Mobile Association of India versus RBI. In 2018, the RBI issued a circular that prohibited banks from providing services to cryptocurrency exchanges. Without banking access, the domestic crypto industry was essentially dismantled overnight. The Supreme Court quashed the circular by applying the doctrine of proportionality. While the justices acknowledged the RBI's power to regulate virtual currencies, they ruled the total ban was disproportionate because the regulator failed to present empirical evidence of actual harm suffered by the traditional banks it was trying to protect. The ruling drew a firm line. The RBI possesses immense technical authority, but when restricting a citizen's fundamental right to trade under Article 19(1)G, it must rely on hard evidence and use the least restrictive measures possible. The RBI has evolved from a traditional monetary rate setter into a proactive technology regulator. As of 2026, it is executing a modernization effort, consolidating these rings of oversight into what is termed the regulatory reset. This includes the mandatory adoption of the Mule Hunter AI tool. Every regulated bank must deploy this specific artificial intelligence framework to detect and neutralize complex cyber fraud networks in real time. At the sovereign core, it is rolling out the digital rupee. By deploying a programmable e-rupee, the RBI is shifting its currency monopoly from the printing of physical paper to the governance of user-level code. For the public, it has streamlined consumer protection through the 2021 Integrated Ombudsman Scheme, creating a centralized portal capable of awarding up to 20 lakh rupees in compensation for banking failures. Yet, despite this autonomous architecture, there is one ultimate caveat to the RBI's power: Section 7 of the Reserve Bank of India Act. This specific provision allows the central government, acting in the public interest, to issue binding directions directly to the RBI governor. It is the final democratic check ensuring the bank answers to the state. By balancing its statutory authority with constitutional limits and modern technology, The RBI serves as the ultimate adaptable guardian of India's financial sovereignty.